be more helpful in replying to your queries. I would now like to invite Syed Amir Ali, Meezan Bank's Deputy CEO, for his opening remarks. Amir sir, please, sir.
Bismillah ar-Rahman ar-Rahim. Assalamu alaikum. I am pleased to welcome all of you in the analyst briefing of Meezan Bank Limited. And as you know, this is something which we love to do. We love to explain what we have been during the last few quarters and what we are aiming to do during the upcoming year, next quarter. So this session will start with a presentation from our CFO, Syed Imran Ali Shah, followed by a question-answer session, whereby I and Imran and rest of my colleagues will try to answer all those questions posted by you in the best possible manner. So over to you, Imran, and thank you, Suhail sir.
Thank you, Amir. Am I audible, Suhail sir?
Imran, yes, you are, sir.
Okay, thank you. So I would skim through some of the slides. First of all, welcome everyone to the analyst briefing session for Meezan Bank. As Amir mentioned, both of us are looking forward to hearing your questions and trying to answer them to the best of our ability. It has again been an excellent quarter for the bank, where the profit after tax has come in at 77.5 billion on a
recording in progress
basis, which is up by 34% year-over-year. Total assets have grown by 12% compared to December 2023 to close at 3.4 trillion, whereas basic earnings per share for the 9-month period have come in at 43.26 rupees. Deposits have been up 15% over the last 9 months to close at 2.56 trillion, whereas ADR has been around the same level as we had at December at roughly 44%. Return on equity for the 9 months period has been 50%, whereas we have opened 11 new branches over the past 9 months and currently stand at 1,015 branches spread across 339 cities in Pakistan. If you look at some of the other key financial ratios, cost to income ratio has further improved slightly from 29.9% to 28.6% compared to the corresponding period last year, whereas return on equity has gone down slightly, primarily because of a larger equity base as we have been building capital over the past few years to set us up for future growth. Capital adequacy ratio for the 9 months was 27.31%, which is up against the September 2023 numbers of 23.37%. CASA mix has also improved from 88 to 90% over the last 12 months, whereas on a 12-month basis, we added 32 new branches. In terms of gross financings, despite the competitive landscape, we have been able to add roughly 165 billion to our financing portfolio, which is a growth of 17% year-over-year, whereas the gross ADR has gone down slightly. However, I would like to mention that despite the challenges and the competitive landscape, the bank remains confident yet cautious that we would be able to meet the 50% ADR threshold by the end of the year. Non-performing financings have gone up slightly by 2.9 billion, whereas our NPL ratio has been at the same level numbers. In terms of investments, we have added around 191 billion worth of additional sukuks to our portfolio, and the total investments portfolio at the end of September 2024 stood at 1.74 trillion. If you look at the detailed year-over-year P&L comparison, net spread earned was up by 39%. This is roughly driven 70% by the rate increase and 30% by volumetric growth in our average assets. Fee commission and other income was up 22%, whereas foreign exchange income is down 71% compared to the preceding period. Dividend income closed at 1.1 billion, which is up by 82%. And we have also had capital gains to the tune of 0.3 billion. Total income for the 9-month period was 233 billion, which is up by 37%, whereas operating expenses and other charges have also gone up by 31% over the same period, primarily driven by variable compensation expense, as well as our IT expenses and inflation-driven expenses. Profit before tax was up by 40%, whereas profit after tax was up by 34%, primarily because of higher effective tax rate, where we have taken an ADR-related tax provision on the basis of abundant caution to the tune of 6 billion rupees. If you look at the full year numbers and the time series analysis, our profit after tax has been registering significant growth over the past few years. And last 3 years, CAGR PAT growth has been around 58%, with September already showing a 34% increase compared to the 9-month period in ending September 2023. And this is despite higher tax rates at 49% being applicable since 2022 compared to the tax rate of 39%, which was applicable on the banking industry prior to 2022. On a quarterly basis, our profit after tax has registered a slight decline, where PAT has gone down from 26.7 billion to 25.8 billion. But excluding the impact of taxation, where we have taken a higher ADR-related tax charge, PBT was up by 6%, and this has been our best quarter to date. Profit before provisions were up by 13%, whereas net spread earned has been up by 9%. In terms of the balance sheet numbers, total assets were up by 12% compared to December 2023, where Islamic financing and related assets have been up 13% compared to December, and around 17% compared to September 2023. Investments are also up by around 11%, whereas deposits have gone up by 15% compared to December 2023 and 27% compared to September 23. Moving on to the key ratios, as you can see on the screen, our return on equity has been registering a healthy upward trend despite the expansion in our equity base, and our return on equity for the past 2 years now has been over 50%. Return on assets have crossed 3% last year as well as this year. The 9 months average return on asset has been 3.24%, whereas our cost to income ratio has been declining steadily since 2021, and for the past 2 years has been below 30%. Similarly, another key ratio for us has been the gross ADR, where we have been trying to maintain an average ADR of over 50% since 2021. Obviously, as the ADR-related tax was not applicable in 2023, our gross ADR number went below 50%. However, we are quite confident that by the end of the year, we would be able to again increase this ratio to over 50%. Similarly, we have a very comfortable CAR position where our capital adequacy ratio is currently north of 27%, with our CET1 ratio being 22.34% versus a minimum requirement of 7.5%, and our Tier 1 ratio being 23.08% versus a requirement of 9%. On the financing side, despite the expansion in our financing portfolio, I'm pleased to note that we have been able to maintain our non-performing loans ratio below 2%, and consistently now for the past 4 years now. And at the end of September, our NPL ratio stood at 1.7%. Conversely, our NPL coverage ratio has been in excess of 170%, closing at 179% for the period ending 30th of September. In terms of the composition of our financing portfolio, roughly 78% of our portfolio is in top-rated blue-chip corporate customers. Around 14% is in mid-market, commercial, and SME clients, and roughly 7% of the portfolio is in consumer financings, primarily related to car financing and home mortgages. We are currently carrying a total provision of 34 billion, of which roughly 20.6 billion relates to stage 1, 2, and 3 ECL charges under IFRS 9, and around 13.6 billion general provision over and above the IFRS 9 requirement. In terms of our investments book, our total investments book stood at 1.7 trillion at the end of September, which is an increase of 11%. Of this, roughly 76% is in variable rate sukuks, whereas 24% or roughly 378 billion is in fixed rate sukuks, where the average yield is around 12.25%. Again, deposits have been showing a healthy and steady increase. Our CAGR growth in deposits since inception has been 34%, which we were able to maintain last year as well. However, given the ADR-related pressures in Q4, we expect our deposit growth to be more muted compared to our historic growth rates, which is part of our deliberate strategy to meet the 50% ADR threshold. Again, if you look at the deposit mix, 47% of our total deposits are current account or non-remunerative accounts. 43% is coming from saving accounts, and roughly 10% is term deposits. In terms of the growth compared to December 2023, in current account deposits, we saw a growth of 9%. In saving accounts, the growth was around 26%, and on an overall basis, we had a growth of 15%. In terms of our fee, commission, and other income, which registered a growth of 22%, the main drivers here are debit card-related fees, which is up by 18%. This is primarily due to addition of roughly 435,000 new debit cards over the past 9 months. The other main driver was trade-related fees and commissions, which were up 22%, and branch banking-related customer fees, which is up by 31%. Similarly, fee income from our subsidiary Meezan Investment Management, which is the largest AMC in the country, was also up 68% compared to September 2023. In terms of the trade volumes, as I had mentioned in our previous briefing calls, we have tried to shift our focus away from purely import-driven trade to maintaining a balance between imports and exports. And I'm pleased to note that now around 44% of our total trade volumes are being driven by exports, and roughly 56% is being driven by imports. So in terms of the total volumes, we have seen a growth of almost 300 billion in our trade volumes year over year. In terms of Meezan Investment Management, which is the subsidiary of Meezan Bank and the largest asset management company in the country, we are pleased to note that the assets under management have increased by 33% from 431 billion to 573 billion over the past 9 months. And we are now catering to the investment needs of more than 350,000 customers, which is the largest in the country. The profit after tax of the subsidiary was 1.5 billion, and the subsidiary returned an ROE of 39.3% over the 9-month period. In terms of our digital offerings, Meezan continues to lead from the front on the digital side. Our mobile banking app continues to be the highest rated mobile app across both Play Store and App Store, with a rating of 4.8. And our debit card spend has also registered a significant growth of 31% over the past 9 months. During the same period, IBFT transactions have registered a growth of 50%. Bill payment transactions have increased by 21%, and debit card transactions have shown a growth of 41%. In total, during the past 9 months, there were 445.1 million logins, which is a growth of 34%. Some of the key metrics that I would like to share with you are on the screen. So in terms of the total debit cards, we have added more than 400,000 active debit cards to our portfolio, and our total portfolio stood at 3.7 million, which is one of the highest proportions compared to a customer base of 5.2 million in the industry. Our POS machine deployment also continues to register a healthy trend, and our POS machines deployed across the industry have gone up from 16.5 thousand to more than 24,500 over the past 12 months. Number of active customers on the mobile app have also increased from 1.7 million to 2.3 million. And digital throughput has also increased, with total digital throughput over the last 9 months coming in at 5.91 trillion. That brings us to the end of the presentation. Both me and Amir would be happy to take any questions you might have. Thank you.
So there are no raised hands at the moment. We have one question on chat. The question is that at the start of the year, the management targeted adding 40 to 50 branches in 2024, but so far they have only added 11. Why has there been such a slow progress?
Maybe let me answer. So there are two reasons for that. First reason is we have already opened some branches. Now our number is 1015. But there are other 35 odd branches which are under construction, which will be opened during this quarter. So what happens when an year starts, we look for the places to open new branches. So it is very important for us now to open a branch at our right location, which has a right potential. Now, since we already have a large network, so finding a right locations need more attention to the detail. So once we decide on right location and pick up a right property, then we proceed. So generally, for first and second quarter goes into that. Most of the branches are finalized in third quarter, and then most of the branches are opened in the last quarter. So we'll do the same thing. Plus, due to the declining, I would say, policy rate, we have been even more cautious in selecting a location, as we have to ensure that even with lower net profit spread, we will be able to turn our branches into profit within a period of 12 to 18 months to a maximum of 24 months.
Thank you, Amisam. So we have a question now from Mohammad Tahir. Tahir Sahab, kindly please go ahead.
Hello, Ji, Assalamu alaikum. Mohammad Tahir from Sherman Securities. Sir, I wanted to know your average investment yields, if you can tell me. I think you mentioned 12.3. during the presentation.
So thank you, Tarsab. If we look at the fixed rate portfolio, the average yields are around 12.25%. And on the variable rate portfolio, the average yields are around 20% right now.
Right. Can you also give me the average deposit cost of deposits or cost of funds?
So the average cost of deposits currently is taking into, obviously, this is the
Yeah,
taking into account the non-remunerative deposits as well as around 6.5% to 7%.
right. So the provisions are a bit higher in the third quarter. So do you think it's because of the deterioration in the asset quality, or there is some other reason?
So again, it's we are primarily seeing stress in some specific names, and that stress has been coming in from the steel and textile sectors. We have not seen any systemic increase in risk in our financing portfolio, and we feel confident that we are adequately capitalized and have sufficient provisions to cater for any NPLs. This quarter, we have one or two names, primarily in the textile and steel industry, which are driving the high NPLs.
Right. Sir, one last
Thank you,
question.
Tarsab. Oh, sorry. Okay. So we have the next question is Fawad Basir. Fawad sir, kindly please go ahead.
Assalamu alaikum. Congratulations on a great set of results. I have a couple of questions. First question
Fawad sir,
pertains,
which company are you with, sir?
I'm with K Trade Security.
Yes, sir, please.
So my question pertains to the effective tax that came in for the third quarter. It appears that the bank has taken a provision for the ADR tax. We also saw effective tax higher for UBL. So just sort of a guidance on what were you guys thinking when you were taking this provision? What's the thought process behind this?
So thank you, Fawad, for the question. Meezan has always been a very prudent bank. And as I mentioned during my presentation, we are confident that we would be able to exceed the 50% ADR threshold. However, the risks in terms of the competitive landscape, in terms of the bidding patterns that you might have seen recently in the commodity financing related financings, do show that it is a very competitive landscape right now. So being a prudent bank, although we are striving for a 50% plus ADR, we wanted to continue with our approach and provide sort of some provisions related to ADR taxation for the 9 month period. And that was primarily the thought behind providing a partial provision for ADR related tax.
Right. And my second question is pertaining to your interest rate outlook. So there's a analyst briefing earlier in the day as well, and it was Bank of Falas, of course, and they are of the view that interest rates may reach 12% by January 2025. Do you have a similar outlook on interest rates going forward?
We are expecting the policy rate to go down by 3.5% to 4% by the end of the year. And we feel that for the next 6 months, i.e., the first 6 months of the 2025 financial year, the quantum and frequency of the rate cuts might slow down a bit. So we expect the policy rate to be anywhere between 13 to 14% by December.
All right. Thank you, sir.
Thanks, sir. We have Mr. Raza Jafi. Mr. Raza, please go ahead, sir.
Thank you, Sir Saab. Thank you, Imran Amir, for doing this presentation. Couple of questions. My first question is that if you go by press reports and see what the government and central bank are trying to do, they're trying to have a fully Islamic banking system in Pakistan by 2028. So A, is that realistic? And B, do you expect the conventional banks to accelerate their transformation or push their Islamic business more? And therefore, how does Meezan, believe that it can, does Meezan believe it can withstand greater competition in the Islamic banking space? So that's the first question. Once you answer that, I'll ask the second.
So let me try to answer this question. So frankly, we feel this is a good thing which is happening for Islamic banking in Pakistan, because by design, 95 to 96% of the population of Pakistan is Muslim, and there is an inherent demand for Islamic finance and Islamic banking in Pakistan. So if we look at the current share of Islamic banking, it's roughly somewhere between 22 23%. And we have seen other similar economies which have been growing at a very decent rate. So if you look at Malaysia, which has grown up to a roughly 45% share of Islamic finance in the economy. And one thing which has significantly contributed to that growth in Malaysia has been the decision of their government to use Islamic finance more for raising new financing for their their development needs or their budgetary needs. So I think that will play definitely a very important role as we decide to move both in terms of public finance and private finance into Islamic space. And in terms of banking, naturally, I would say most of the banks are to some extent ready to convert themselves into an Islamic bank, because most of the banks have either Islamic banking subsidiaries or Islamic banking branches slash windows. So it will not be a difficult process. It will indeed, though it would be a time-consuming process, and a sufficient time is given till 2028 to do that. So it's fairly realistic to make uh, decent progress for conversion of for conversion of entire banking system to Islamic banking system. In terms of competition for Meezan Bank, naturally, Meezan Bank even today compete in the total banking space, and we always believe that one of our key USP is our customer value proposition in terms of our customer service, the type of products which we offer, our presence across Pakistan, our digital channels, as Imran showed to you, they are very robust, very stable, very user friendly. So it's a combination of that. Though overall competition will increase within the Islamic banking space, but we always feel that we have to compete as Meezan Bank into the total banking space. So we feel actually that our share uh, will remain similar to what it is today, because we calculate our share in terms of total banking, and we are growing our market share every year. So it will continue to grow. And this move will actually be more beneficial for Meezan Bank, because now there will be much wider acceptability and marketing and promotion of Islamic banking as a service for all the individuals in Pakistan. So we take this as an opportunity.
Perfect. Thank you. Thank you so much. Makes sense. My second question is that, with the bank's ROE at about 50% these days, I mean, I understand that that probably reduces the need to increase your payout ratio right now. But going forward over the medium term, once we're in a normalized part of the policy rate cycle, is there an optimum CAR level that the bank has in mind?
So Imran, can you answer? Because there is, for maintaining our rating, we have to maintain a certain capital adequacy ratio, which I also know, but if you can specifically mention.
So, in terms of the Raza, your question, I mean, optimal CAR is really a moving goalpost. To maintain our AAA rating, obviously, we require a CAR in excess of 16%, so that we are way ahead of our threshold. But going forward, given the low policy rate, I feel that demand for credit would increase. And obviously, we would also not want to concentrate our lending portfolio towards only government and government-owned entities. So as we sort of look to expand our financing portfolio in on the private sector side, that would attract higher RWAs. And we feel that once the operational risk charge as well as the higher RWAs that the private sector credits attract are taken into account, our CAR would go down. We'll still be maintaining a comfortable buffer over and above the requirement, uh, both in terms of the minimum stipulated by the regulator as well as what we need to do to maintain our AAA rating. But there are a host of factors which would bring down our CAR in the medium to short term. And hence why we feel that CAR is not the main driver which would stipulate where we maintain our dividend payout ratio.
Got it. Thank you so much. Congratulations on a great set of results and good luck for the future. Thank you.
Thank you, Reza sir. We have a few questions on chat. So one question is, how much additional tax expense has the bank incurred in 9 months 2024 due to the lower ADR? This question is from Sunny Kumar of Topline Securities.
So over the last 9 months, on a cumulative basis, we have taken an ADR-related tax charge of 6 billion.
Thank you. One question is, okay, so if Meezan Bank meets the ADR-related benchmark, can we expect a reversal in fourth quarter? How much ADR-related tax have you charged in 2024 to date? I think, sir, you partially answered the question already.
I've already answered. Yeah, thank you, Sohail Saab. I've already answered the question. In terms of the first part of the question, I think it would be very difficult for us to answer a hypothetical question because we don't right now know what the situation would be in December. We remain confident, but there are a lot of moving parts here, and it would be very difficult to predict what happens at the end of the year. Thank you.
Thank you, sir. One last question we have from Mr. Abdul Muqit is, what is your strategy to meet the ADR benchmark, either through slashing deposits or aggressively increasing advances?
So in terms
yeah, so please go ahead, Imran.
So I was just going to say that, we continue to maintain a hybrid strategy, both in terms of rationalizing our deposits. The focus continues to be on building our low-cost current and saving account portfolio. But obviously, deposit would have to be rationalized. And at the same time, we are looking at both our existing customer base as well as acquiring new customers in order to grow our financing portfolio. Amir Saab would be able to provide some more color on this.
Yeah, I think I would agree with Imran. So this is what we are doing. On one hand, we are ensuring that we rebalance our deposit book and we keep all those deposits which are more profitable for the bank, and we try to move away from those types of new deposits which are not profitable. So that will help us to contain our deposit book. And on the other side, naturally, we are trying to be more active in booking new clients, in deepening our relationship with new clients by meeting their financing needs proactively, while ensuring that we maintain our credit discipline.
Thank you, sir. One question we have from Mr. Abdul Muqit is 31% OPEX growth in 9 months despite new minimal branches. How much OPEX can we see going forward?
So again, Mukit, if you look at the breakdown of our expenses, which are disclosed in the accounts, the majority of this is related to the performance of our staff, as well as our OpEx expenditure related to IT, as well as energy costs, which have obviously gone up and over which we don't have control. So I think going forward, as the inflation comes down, we expect the OpEx growth to also rationalize. But as we continue to grow our physical network, as well as uh, sort of invest in our digital offerings, I feel that our OpEx growth would continue to be in the mid to early teens uh, over the next 12 months.
Thank you, Nasab. We have one question. We have a raised hand, Mr. Faiz Sultan. Faisal, please.
Thank you very much, Suhail Saab. Amir Saab and CFO Saab, great set of results. And second thing, I much appreciate, the, you know, जो Meezan Bank has, really made a great leap in the digital offerings, as we have seen from last year till now. My question is regarding Amir Saab. In the last corporate briefing, you have priced us on that there are various software Meezan Bank is working on various software infrastructure to, beef up the offerings going forward, and obviously, uh, you know, uh, probably beef up the offerings, probably, I think, if I recall it correctly, right? So can we give us more updates on that front? Where are we on that on that front, please? Thank you.
Okay, thank you. This is a good question. I would love to answer this. So, what Meezan Bank is doing in terms of the application side of our digital strategy, that we technically are using three platforms which are among the top in the world. So, for our core banking, we have Terminos, and right now we are in the process of upgrading our Terminos from R16 to R24, which is right now the latest version available. Side by side, we have moved to one of the best switching system or the middleware, which is BBC. Earlier, we were using a locally developed processing our digital transactions, which includes transaction coming onto into the bank through POS channels or our mobile banking application or ATMs of our own self or of other banks. So that stack is completely being moved to a new system, which is among the top in the world. So it is one of the top two best systems available in the world. So we have acquired that. A lot of services have already been moved on to that, and remaining services are being moved. And the last one more application which we are using, I would say we call it a platform, and that platform is OBDX. So in this day and age, organizations want to become more agile in improving their digital offerings. And for that, you need to have platforms. So we have acquired one, which is OBDX, which is an Oracle application, and it is for the UI UX, which means it is for the front end of whatever we are offering digitally. So our new application, mobile banking application, there is a beta version already available in the App Store, and there are users who have signed up as a beta tester are using them. All of the employees are using them. It is a much richer experience, and we want to launch it on a large scale only once we are fully confident about its functionality and performance. But you can as an individual can start using that beta version today also. Plus, we are also using the same OBDX platform for developing other services and application, which includes the corporate banking related portal, which includes supply chain related portal and consumer banking related portal. So this is a platform which enable us to develop so many things on it. And for our own internal digitalization, which primarily involves using business process modeling or digital documentation, we have acquired an IBM product, and a lot of our internal credit approvals, are being moved into that new product. So we are trying to become as much paperless as possible going forward. So we are growing our digital footprint on all dimensions, and all these tools are one of the best in the world.
Thank you, sir. So there are no further raised hands. We have one question from Fawad Basir. Any more headwinds expected from the steel and textile sectors?
So let me try to answer that. So if you look at the steel sector at this point in time, steel sector suffered because of two things. One was demand shrinkage because of a lower construction activity, and demand for some of the plants went down to as low as 25 to 30%, both in long products, which is your bar products, and even in flat products, which are used in automobile related industries. But side by side, on one hand, there was a reduction in demand. On the other hand, there was a massive increase in power tariff. So all those steel making companies which were using commercial power, they couldn't sustain the increase in operating costs with a decreasing demand. So we have seen a couple of defaults in Pakistan steel manufacturing industry. I don't like to name them. You already know them because some of them are already listed. Now, other steel manufacturers, most of them are, which are currently meeting the demand, have their alternate power generation sources. So many of them are linked to a sugar mill. So the bagasse, which is being used for producing electricity, the cost per unit is roughly 16 rupees per kilowatt hour versus roughly 50 rupees, which the commercial power source for the producer which are using commercial power source. So I think there are no more headwinds. Actually, what I feel that with reduction in interest rate, with growth in economy, with positive current account deficit for the last month, so I would say surplus for the last month, things will improve. So no more headwinds for steel sector. Rather, these sectors will revive in terms of Meezan strategy. Although very few banks have make a full 100% provision against these accounts. Most of them are keeping roughly 25% provision in their books, but Meezan Bank has provided against these accounts 100% of the outstanding facility. Coming to the textile sector also experienced a challenge because of three things. On one hand, the cotton price at which they booked their cotton for the 2024 was higher, and that then later on the cotton price crashed. And as a result of that, you already see that the rural inflation is lower than the urban inflation as published by PBS. So on one side, they have an expensive cotton in hand. On the other side, they were operating on commercial power, many of them. So the commercial power tariff was increased. But very recently, two things has happened now. For this season, they are procuring cotton at a lower rate, both local cotton and imported cotton. On the other hand, interestingly, the price of yarn has gone up. So these two things are helping the textile industry for the coming year. So I don't see any stress on the textile portfolio going forward. Plus, because of the recent political issues in Bangladesh, a lot of buyers have moved to Pakistan. So somebody's adversity is our, I would say, opportunity. So a lot of buyers are now coming to Pakistan. So textile sector will definitely perform much better in the coming season than it as compared to its performance in the last season.
Thank you, Amir Saab. We have one raised hand by Sayyida Khadija. Ms. Khadija, please go ahead.
Actually, I was waiting for that question, and when we started the analyst briefing, so Imran gave me a heads up that you should be ready for this question. So yes, in terms of MDR, let me share at this forum that in one way, Islamic banks are already under an MDR. Only the formula is different. So we have a profit distribution pool mechanism under which 50% of the revenue which comes to us from our from our advances or financing and investments goes to the depositor, and 50% comes to the bank. Against that 50% which comes to the bank revenue, bank has to absorb all operating costs, all taxes. So everything is borne by the bank out of this 50% share, and even Meezan Bank at times share roughly 50 to 60% of its 50% share with the depositors to increase their return on deposit. So this is a formula which is already there, so which works like a minimum deposit operating framework for Islamic banks. Plus, there is another condition that the highest rate which an Islamic bank pays on its deposit, a particular type of deposit, say TDR, the lowest rate it is giving to any other depositor should not be less than 1/3 of the highest rate. So Islamic banks also operate under a regime which is kind of a minimum deposit framework which they follow. Now, generally, when analysts ask for a question about minimum deposit rate, they try to link it up with the conventional bank's minimum deposit rate, which is linked to the policy rate or the floor rate minus certain basis point. So I think from a Sharia point of view, this is not possible for Islamic banks to follow that kind of pattern because we share our profits with our depositors under a mudaraba mode. So, but still, State Bank has been working on revising the profit distribution pool framework. That working is still in process. We have not heard anything about it from central bank for quite some time, and with the decreasing interest rate, I think now by design the delta between the highest rate and the lowest rate will shrink to a level that it will automatically become a decent play for both types of institution and both types of depositors. So I think I don't see any such thing now being planned or prepared at a active very actively. But if something comes up, we will follow that and we will align our strategy according to that new framework.
Thank you, Amsa. So we have no more questions on chat and we don't have any raised hands. So I'm guessing that everybody's questions have been answered. Amit sir, thank you very much. Imran sir, thank you very much. We'll end the session now and thank you everybody for joining us. It has been a pleasure having you with us and we look forward to seeing you in the next analyst briefing session, inshallah. Thank you very much. Assalamu alaikum.
Assalam.